I want to bring in our first guest. Andrew Smith is the Chief Investment Strategist at Delos Capital Advisors. Andrew, great to have you on here this morning. You got a bunch of charts, and we want to start with them because now there's this fear that things are going to get ugly in the U.S. economy, like we see around the rest of the world. How do you assess what that means for equities?
Yeah. First, thanks for letting me be here today. It's good to see you, Oliver. We've looked at data probably since 2018, around June and July, and started seeing a lot of slowing in our economic growth, and that trend continuing to come out and signaling within the bond market. And we believe that the fundamentals began detaching from the risk asset spectrum, such as equities, and we continue to see that going on until probably the second half of 2020 or the first quarter of 2020. And so we recommend always that more defensive tilting within the equity markets.
How damning do you think the data is right now, Andrew, for the economy? I know that you've got a chart with some of the leading indicators. They've started to turn south. My question has kind of been, all right, what tools are investors and strategists going to use to figure out if this is the real deal coming into a big recessionary slowdown, or if it's going to be 2015, 2011 redux, where we're kind of in the same realm right now in terms of some of these indicators. They haven't gone, 2008 level by any means yet.
Yeah, that's a great question, and that's kind of the knife's edge that we have to kind of contend with right now. The biggest thing that we've seen is the leading indicators, which is turn one on this chart, really start to roll over, which is, the stock prices, the ISM new orders, the yield curve spread that we've seen already invert from the 10-year and 3-month. But now we've started to see confirming data in the lagging indicators, which is turn three over just the last month. Now, while employment numbers have stayed relatively strong, and then, the initial claims 1 month is a little bit noise, we're seeing data, though, really start to change up where companies have actually started to lower their hiring and not really wanting to compete for wage price increases, while some have. So I think that this will manifest further in the next 2 quarters, where the coincident indicators will continue to confirm the slowdown. The comparison to 2015 is very good. I think that the problem with the difference between there and then is really the amount of tightening that we've had in the system. So the 10-year Treasury yield had one of the highest rates of change in really just over a 2-year period that we've ever seen in the history of the time series. So that will have profound implications on our risk asset spectrum. And we think that this is very different from a 2015 and even potentially a 1994 slowdown scenario.
What's important to point out on the chart is that these indicators did get pretty worrisome right around that bottom 2016. We're actually not even there yet in terms of the level. It's the trajectory then, and that they're aligning together. What will you be looking at once we get down to those areas of, how to confirm that this gets worse? I mean, I know it's impossible to have a crystal ball, but any idea kind of what you'll be drawing from to assess how rough it might get?
Yeah, so we're continuing to look at the fundamentals from the revenue exposures. Cisco reported yesterday, and the revenue kind of guidance over the next quarter was essentially flat, and we're seeing that across the board. Is that while earnings this quarter have done rather well, 74% beat for the earnings that have come out so far, which is pretty much majority as of yesterday, we see guidance really getting slashed. And looking at the fundamentals, we think that guidance has only been slashed by 1 quarter, and we see continued cutting in guidance and analyst expectations in the coming, which I think will be the next catalyst for the risk asset or our equity markets as analysts really start projecting in kind of this slowdown. And we look at ISM New Order Index to really confirm that, which has been on a negative trending basis for about 18 months. So we expect this number to go into the contraction territory, which is our 50-line mark for the ISM headline index, actually in the next coming quarter.
Now, when we look at some of these economic indicators relative to periods of recession, obviously this is now the question people are asking post-bond inversion on 2s, 10s is, all right, do I want to try and play stocks in this historical period between inversion and the real recession? What is your view on that? I mean, is it basically trying to, pick up pennies with the, on the train track, or is there really a defensive part of this market that will withstand whatever's coming? Because, I mean, people think Staples defensive, and then we have companies like Kraft Heinz or Dean Foods whose products are now outdated and they're getting killed. There's nothing defensive about those.
Right. That's a great question, and that's what we have to kind of take a step further in our investment mandate. You know, it's really hard to time the market. As you actually brought up yesterday, the yield curve inversion between the 10 and 2s really can lead a recession out between 2 months to 2 years. So picking when to get in and out of the equity markets chooses to be very challenging. So what we end up doing is finding the most defensive factors within the most defensive sectors of the equity market. So we'll go look at consumer staples, but instead of buying the sector blindly, we'll go in there and look at really what has tight earnings variability between analyst expectations, what has a low beta within that industry group, what has enough cash on hand to sustain a dividend growth rate. You know, dividend actually as a factor in of itself from sustainability and growth has been the best performing factor since 2010. So in periods where rates continue to move low, negative rates globally, ex-US, we think that that will be another paying off factor to be in if you have to maintain equity exposure. The S&P low volatility index has been a great place, hasn't given you a lot of alpha per se, but if it hugs that zero line mark, you have less of a recovery rate that you have to achieve when things get better in the next 2 or 3 quarters.
When you look at the nature of the S&P versus these two areas, defensives and cyclical risk assets, I like this chart you brought up because it does show obviously over the past roughly year and a half or so, there's been a outperformance by some of the defensives, not a ton of alpha to the S&P, more just, you know, avoiding some of that downside that's happened. So does this basically mean steer clear of cyclical names like semiconductors or housing here domestically? How does one define a cyclical risk asset now in a globally connected economy?
Yeah, I think really we stayed clear of the cyclical space, and that's kind of what was our most contentious kind of theme last year, given kind of the infrastructure bill that has taken a long time to come to fruition and the tariff situation that we obviously are experiencing to this day, to really stay away from that cyclical spectrum and kind of get into those defensive assets. So it is industrials, it's things that are tied to cyclicality growth within the United States and globally, and it being also very much tied to, as you said, the global economy. We've seen supply chains collapse. We've seen sales growth in the semiconductor space collapse. And so we just all together stay clear of that whole spot.
And as we speak, about 8 minutes ago, industrial production came in lower than expectations. Doesn't seem like the market was a big fan of it, but we're still up. Andrew, before we let you go, last point. With all the narrative around what the Fed has done and the predictability of cuts to come, that seems to be the very broad consensus. I want to end with one last chart about Fed hopes versus fundamentals. Your point is now the market has been driven by hope, basically, off the lows. I think that's been our narrative too when you just look at multiple expansion. What's the implication of that? Don't hang your hat on Jay Powell saving the day?
No. It's actually quite great. You know, we had last year, Jay Powell kind of came out and, you know, as we call him here, Papa Powell, he basically was saying he slept well at night, everything was great. This was summer of last year, and then he did the most amazing Powell pivot in December, which has sparked one of the best year-to-date rallies that we've seen, I believe, since 1987, but that has been driven purely on speculation that the Fed will save the day. But given the yield curves on the 10 and 3s that we saw a few months ago, and now the yield curve on the 10 and 2s, and then the industrial production declining, the amount of credit debt that is expanding, we think that really buying the S&P without any fundamental basis for earnings per share growth or EBIT growth, that is really kind of a challenging environment to be in and could be pretty fruitless if the stock market decides to detach or reattach back to its fundamentals.
Yeah, all right, and the blue line there, EPS coming down while the valuations go up. It's been a chart we've been running here, and I love it, so I'm glad you reminded us of it and brought it this morning. Andrew Smith, Chief Investment Strategist at Delos Capital Advisors. Really good stuff here this morning, Andrew. Nice job.